Good afternoon or good evening, everyone, and welcome. Thanks for joining us today. My name is Andy Susanin. I lead the team here at RIA Midwest. We are a fee-based advisory firm located in Des Moines, and we're dedicated to helping clients prepare and thrive in retirement. I'd especially like to welcome our valued clients today, as well as those of you that are joining us for the first time through social media or through an invitation. We're sure glad you're here. At RIA Midwest, we believe our clients deserve the best information possible, especially when it comes to retirement decisions like Social Security. That's why we partnered with Social Security expert Charlie Gipple to help you better understand your options. Well, for many people, Social Security is one of their biggest retirement assets. Yet, billions of dollars in benefits are left unclaimed each year because people either file at the wrong time or they just aren't aware of the strategies that are available to them. Today, we'll cover when to claim benefits, how your decisions can impact your lifetime income, spousal and survivor benefit opportunities, taxation, and other key strategies to help you make good, informed decisions. With that, it is my pleasure to introduce our speaker, Charlie Gipple. Charlie is a nationally recognized expert in retirement planning, Social Security, life insurance, and long-term care. With more than 20 years of experience educating financial professionals and consumers, Charlie's the founder of the Retirement Academy. It's a financial columnist for Broker World. He's a sought-after keynote speaker who has partnered with leading industry experts, including the $1 Million Roundtable. We're excited to have Charlie with us today to share his insights. Charlie is an Iowan, born in Atlantic, raised in Corning, and Charlie now resides in Des Moines with his wife and 2 sons. Please join me in welcoming Charlie Gipple.
Beautiful. Thank you, Andy. I appreciate that. Well, it's not evening yet. Good afternoon, everybody. Soon to be evening. First of all, I want to thank you for joining the call today. Secondly, I want to congratulate you because, well, I'll just say that this process that you're about to go through sometime, whether it's a year from now, 5 years from now, it's a extremely important process. It's a matter of, if you do not do it correctly, you could be possibly leaving hundreds of thousands of dollars on the table, right? Andy, as well as myself, we do this analysis every day for our clients on how to optimize Social Security. And I will tell you that, as Andy said, number one, that it is very easily the largest asset that a lot of our consumers are, a lot of our clients have. $1 million plus in a lot of cases in income that can be coming into you over your lifetime. But secondly, the difference can be something like, hey, instead of getting $1 million in Social Security income over your lifetime, what if we're able to get you 1.2 or 1.3 million, right? So the point is you are not leaving money on the table by further educating yourselves on Social Security. So I want to congratulate you. So here's what we're going to talk about today. Actually, the first thing that I want to talk about is a word from our attorneys here. Basically, what they say is Social Security is specific to each and every one of you, right? A lot of folks that have attended our hundreds of webinars and seminars over the last handful of years, I would say that you do not walk away from this webinar knowing exactly what to do, just exactly what to do. But I will promise you this, you will walk away from this webinar today understanding what things you need to take into consideration and how to craft your strategy when it comes to Social Security. And by the way, in the evaluation at the end, we are actually going to ask you if you want a free Social Security optimization plan. So a free retirement income plan that includes us saying, hey, based off of what we see here, this is what we would advise you when it comes to the timing of your Social Security. Oh, by the way, we're going to have fun throughout this presentation today. Over in the chat pane, You guys can chat along if you like as we go through this. Tell me if you have questions as we go through this. If you have any points that you want to make, I promise I won't throw out your name, maybe your first name or whatever. Hey, it looks like Heather, for instance, already said grateful to be here. Thank you, Heather. I appreciate that. But if you guys and gals want to correspond with me as we go here, that would be good in the chat pane over there or the Q&A pane. Some of you are on your iPhone, which can make it hard to type things out. But as we go here, you'll see that these are pretty interactive that we do here. People appreciate interactivity, right? So the first thing that I will say about Social Security, and I'm going to give you a couple different examples here before we dive into the nitty gritty, is this: that when we talk about optimizing our Social Security, maximizing your Social Security, many times optimizing your Social Security is about more than just you, right? So let me give you an example. And the end point here is that Social Security, there's just so much more than meets the eye. People tend to oversimplify it in their head and say, oh man, I'm going to live, I have good genetics, I'm going to live forever, so I should file late. Oh, I'm going to die young because that's my genetics, so I should file early. That's greatly oversimplified. For instance, I'll give you my scenario here. My dad died at age 62. A lot of the Gipples, they haven't made it out of the 60s, a lot of them, right? So I don't have a whole lot of longevity in my family. Heck, I shouldn't even buy unripened bananas anymore, right? I might not be around to eat them. No, I take better care of myself than my family has, or my dad and my uncles have. But let's just assume that I have really bad longevity in my family. So, with that little tidbit of information that you have, put in the chat pane, when should Charlie file for his Social Security benefits? So you're the advisor now. You're telling me when I should file for my Social Security benefits. Should I file early? Should I file on time? Or should I file as late as possible? Somebody that does not have a whole lot of longevity, when should that person file for their Social Security benefits? Marsha, excellent. It depends. Tim, now. I don't look that old, do I, Tim? I'm not Social Security age yet, man. I'm only 48. Tim's like, yeah, but with that longevity, if you can file now, do it. Everybody's saying early. Well, that's right. That's conventional wisdom, right? That's oversimplified wisdom is, yeah, you file now. Well, here's the thing. Again, Social Security is about more than just your Social Security, at least in a lot of cases. I'm going to do the opposite of what you say to do. I'm actually going to file at age 70. I'm going to file at age 70 because let me give you a little more information. I've been for many years well, for all of the years, the main breadwinner in our household, right? And let's say that my wife's Social Security amount is down here, mine is up here. And when I pass away, let's say I pass away at age 70. Which I'm not going to, I'll live longer than that, but just bear with me here. I pass away at age 70. What does my wife get from a Social Security standpoint when I pass away at age 70, given what I just said? That's absolutely correct. She gets the greater of the two benefits. So when the spouse passes away, you have her benefit, which is this, and you have my benefit, which is this. She inherits my benefit. So she is going to inherit the penalized benefit if I take Social Security early, or she is going to inherit the larger benefit if I filed for Social Security late. Well, but Charlie, how are your wife's genetics? Yeah, that's kind of my point here. My wife's going to live forever because she has fabulous genetics. She could eat McDonald's every day if she wanted to. She ain't going to gain a pound. She's never sick. I kind of envy her for her health, right? She's just got great genetics. So when you add this up, Charlie delaying, if Charlie were to pass away, Noel gets Charlie's big benefit because he waited until the latest he can wait, folks. Which, folks, what's the latest that you can wait to file for Social Security, at least to get a benefit, the maximum benefit? What age is the latest to file for Social Security to get that maximum benefit? Tell me in the comment pane there or in the chat pane. Not 70 and a half. You're thinking the old required minimum distributions, it's age 70. So yeah, so if I file at age 70 and have that big benefit, my wife inherits that when I pass away, she lives forever. A computer program, sophisticated computer programs can tell us, hey, yeah, over both of your lifetimes, even on an after-tax basis, here is the total Social Security that Charlie and Noel can get by Charlie waiting until age 70 versus if Charlie files at age 62. By the way, I just said something that's pretty profound to a lot of folks, or kind of catches people a little bit off guard. Did Charlie just say after taxes, Social Security after taxes? Well, folks, we're going to make you do a little work here. We have a poll for you. Has absolutely nothing to do with a little puppy dog. I just saw that puppy dog slide and I like, you know what? I like puppy dogs. So I'm gonna have the puppy dog here. So Social Security, and I'm gonna launch this poll here in a bit. Social Security can be included in your taxable income. So my question for you in this poll is this. What is the maximum amount of your Social Security, as we'll talk about in more detail here in a little bit? What is the maximum amount of your Social Security that can be included in the tax formula that can be taxable? How much of your Social Security can be taxable? All right, we got some results coming in. It's kind of a split, a three-way race here. Three-way race, pretty much. The leader, the correct one appears to be the leader so far. All right, they're still coming in, but I'm not going to belabor this. So the answer to that question is 85%. That's right. Up to 85% of that Social Security, you paid taxes on the front end, right? That's 6.2%. Or if you're the employer, 12.4%, right? Because you cover Social Security, employee, and employer taxes. You paid that on the front end, and now on the back end, you mean to tell me, Charlie, that up to 85% of my Social Security can be subject to taxation? Absolutely. And it doesn't take a whole heck of a lot of income. And a big part of what we do, what Andy does, RIA Group, as well as myself, is we look at strategies to minimize that Social Security tax, right? Because we do not care how big your gross Social Security check is. We care about how big your net Social Security check is. Okay, with that poll being done now, I'm going to mention something else, a second thing. Oftentimes, your Social Security is about more than just your Social Security. So what do I mean by this? You can have two twins, exact same genetics, obviously. They've had the same jobs over their entire lifetimes. They made the exact same amount of money. Their Social Security amounts are exactly the same. But guess what? When each of those twins come to Andy and or myself and say, when should I file for my Social Security benefits? Do you know that the answer can be completely different from twin A to twin B? That they can have completely different optimal Social Security filing times. Why is that? How is that possible that twin A and twin B can have completely different times, even though all else is basically equal? Well, because Social Security is about more than just Social Security. Again, it's about your net Social Security. So maybe twin A has a bunch of income coming in during his retirement years from traditional IRAs or 401ks that haven't been taxed yet, right? When he withdraws from those accounts in retirement, does that add to his tax bill and hence possibly mean that his Social Security, 85% of it possibly, is subject to taxation? Absolutely. Well, what about the other twin over here, twin A or the other twin? That person may not have any other income coming in subject to taxation, maybe Roth IRAs or whatever. Well, then what does timing have to do with this? Well, because you can adjust the taxation, and this is probably the most analytical we'll get through the whole thing. You can impact the taxation and the after-tax Social Security that twin A gets, for instance, by adjusting the timing, for example. And that is what our system does. Our retirement income plan, our social security plan is on an after-tax basis. How do we squeeze as much social security out of the system as possible? So two very big points here. One, I want to open your periphery when it comes to social security. It's oftentimes about more than just you, like my example with my wife, right? It's about more than just me. It's also my wife's longevity. But also, two, Social Security is also about what other retirement holdings do you have that are going to generate income over your retirement years that can potentially pollute the Social Security pool, so to speak. What do I mean by that? I mean subjecting Social Security to taxation. And we're going to dive a little bit more into that. That's the most analytical I'm going to get throughout this whole thing, I promise you. So, with that as a primer here, tell you a little bit about me, a little bit of my background. I always like to know who it is that's speaking. Is what they are saying valid or not? Sometimes it depends on what their background is. So I'm going to spend maybe a minute. I'll tell you a little bit about me and my background. History of retirement income in America. Guess what? Retirement, this thing that you are approaching, this wonderful thing that you're approaching, wonderful if you play your cards right. This wasn't even really a concept 100 years ago, right? Why not? Tell me in the chat pane, what did we do 100 years ago other than retiring? So in the year 2000, 1926, what did we do instead of retiring? We died. We didn't retire. We died, right? I'll talk with you a little bit about that history and then how it's kind of evolved over the last 100 years to where today it's a very complicated environment. Andy's been in this business helping folks longer than I have, decades and decades, right? And Andy will tell you that today it is the most complicated environment to retire than it ever has. Retiring in 1980 when you had a pension plan that's just going to pay you forever and ever and ever to go away, that's a pretty easy retirement, right? So what's that dynamic that's changed to today to where if you optimize your Social Security, you'll be ahead of the curve versus maybe your peers that are not on this call. Then we'll dive into the nitty gritty. Delayed retirement credits. What's your full retirement age? Tell me, folks, in the chat pane, what's your full retirement age? If you know it, tell me what your full retirement age is in the chat pane. I usually know the bandwidth pretty, the range based off of who joins these calls, but I'm curious what your full retirement age is. I will tell you, if you're giving me a number that's any higher than 67, and by the way, I'm talking about full retirement age for purposes of Social Security. You may say, well, I'm going to retire at 70. Well, but that's not your Social Security full retirement age, as we'll educate you on the relevance of the full retirement age. But your full retirement age cannot be any higher than age 67 when it comes to the technical Social Security FRA. Well, man, Charlie, I was going to wait until age 70. I get it, and we'll talk about that. But anyway, I'm seeing numbers anywhere from 66 in some months up to 68, things like that. So yeah, we'll get into the nitty gritty. We'll also talk about, do you file early? Do you file on time? Do you file late? What's the optimal filing timeline? We'll talk more about Social Security taxation, earnings test withholding. If you file for Social Security prior to your full retirement age and also have a job, guess what? There is a huge amount of your Social Security that can be withheld by the government. Again, if you file early and if you still are making earnings, if you're making an income from a job, for instance. So we'll talk about that, filing early while still working. We'll also go into 3 different case study examples. What happens with this couple if they both file early? Okay. What happens if they both file late? Okay, well, which one of those is the optimal? Neither is. How do we arrive at the optimal Social Security filing time? The purpose of these case studies is so that you can envision what the Social Security maximization process looks like. And people really love those case studies. And again, I encourage you to participate as we go through the call here. Ask questions in the chat pane. And I am getting over a little bit of a cold here, so I apologize for the coughing. But yeah, I was hoping I'd be done by now, but I'm on the back nine of it, I think. So I grew up in Southwest Iowa, as Andy said. For about 20 years, I was an executive of various financial companies, ING when they were here in the United States, and then Genworth after that, and then Salmons. Long story short, at a pretty young age, like my mid 20s, I was a VP of ING, and they had me traveling the country as well as doing like media events, right? So writing articles, you'll see a lot of stuff online if you were to Google my name as well as, Social Security or whatever, and Charlie Gipple. I've done a lot of writings as well as media appearances on Wall Street. Excuse me. That's me on Jim Cramer's show there, the street.com. That's the Mad Money guy. He also owns the street.com. I was talking a little bit about it was about annuities that I was talking about on that session, annuities in clients' portfolio. So once I got sick of the corporate world, so to speak, I said, you know what? I still have these writings that I can do. I still have the media stuff that I can do. I think I'm just going to go out on my own. I still have the contacts. And what I'm going to do is partner with fine folks like Andy and the RIA group. And, what we're going to do is we're just going to further the education when it comes to these things like Social Security. Long-term care, folks. We do long-term care seminars as well. This is a big deal. $120,000 a year expenditure if you can't take care of yourself. Estate planning, tax planning. So I do a lot of things like this in partnership with folks like Andy. Why? Because we want you guys and gals to be smart, to be savvy when it comes to your retirement and have a fruitful retirement. Been doing this for about 25 years. And of course, they're the little letters after my name, which, do they mean anything? I don't know. I know they were a lot of work to get. That's all I know about that. All right, so that's a little bit about me. Now let's talk about the history of retirement income in America. So, yeah, the life expectancy of a person in the year 1900. Take a guess what that was. Tell me what you think the life expectancy of a person was in 1900. All kinds of guesses coming in. 47. 47 was the life expectancy of a person in 1900. Well, around 1930, well, exactly in 1935, the government said, we have a problem here. The problem is people are now outliving their body's ability to perform. People are actually living too long. Um, and they can't work anymore. So how the heck are these people basically just going to sit on a rocking chair for the next 10 years, 20 years, which now, by the way, retirement is a heck of a lot more than 10 years usually. So that's when the government said people are outliving their body's ability to do work like this, like what you see here, the guys on the skyscraper there. So what are we going to do? So that's where the government created this system called Social Security. Yeah, every other week in your paycheck, you pay a certain tax into the Social Security system. Guys, gals, do you know what your Social Security tax is that you pay out of your paycheck? What is the percentage that you are paying into the Social Security system? Put it in the chat pane there. Let's see how smart you guys and gals are when it comes to this. But the government back in 1935 said, yeah, you pay a certain tax every other week in your paycheck. And then eventually, when you hit a certain age, you can do this thing called retirement. We'll pay you for the rest of your life. The answer to the question is the Social Security tax, excluding Medicare, is 6.2%. Pam, that's right. I think Pam's pretty smart. 6.2% is the answer. If you're the employee and the employer, like I am, for instance, I'm paying 12.4%, as Andy is as well, 12.4% to Social Security. So yeah, the system was opened up in 1935. They said, yeah, when you hit full retirement age, we'll pay you to go away for the rest of your life, basically. Well, question for you, what was the full retirement age in the year 1935 when Social Security was created? What was the full retirement age for Social Security purposes in 1935? 65 is the answer to that question. Now, you smart folks on the phone here, on the computer thingy here, are probably thinking the same thing that a lot of folks think, right? Well, if 65 was full retirement age, then what the hell was the life expectancy of a person in 1935, right? Take a guess at that one. What was the life expectancy of a person in 1935? 62. So on average, you were not even going to hit the age to get your full Social Security retirement benefits. Actuarially, that's pretty flawless, right? Where today the math is kind of turned upside down, which brings me to a point that I always want to make. Is Social Security going to be around? Well, Charlie, you're saying that the system was created to where the people paying into it were going to die before ever getting a benefit. Yeah, you don't have to be an actuary to know that that's sustainable. But today, however, a 65-year-old male is going to live until age 85 on average. A 65-year-old female is going to live until 88 on average. The math is all sideways with Social Security. And as a result, is Social Security going to go away for all of us? As the media, the doom and gloom media is saying. First of all, you guys and gals are on this call, so I don't think you're a part of that group that thinks, oh, it's going to go away. Some people, oh, I don't want to hear about Social Security. It's not going to be there. That's false. It is going to be there, right? First and foremost, if nothing changes, but even if nothing changes between now and 2033, when they say that it's going to go bankrupt, right? Basically hit zero. Well, there are still people I'll still be working, what, 8 years from now, whatever that is, 7 years from now, I'll still be working. A million other folks like me will still be working and putting into the system. Well, okay, so if that trust fund hits zero and it's just going off of people putting money into the system, what percentage of my benefit is that expected to cover? Now, this is not a consolation, but it's still 75% of your promised benefit that will still be covered, even if the world goes to hell in a handbasket, even if there is no legislation to protect those that are fully vested, however. However, I will say that I have never seen one piece of legislation proposed when it comes to Social Security that targets those folks like you that are close to retirement, that are close to filing, that are vested in the Social Security system. That legislation to correct the Social Security situation, what is that legislation focused on, targeted towards? My 19-year-old kid, my 16-year-old kid, who has the same full retirement age as me, age 67, right? So a lot of truing up of the system can be done by those folks that are nowhere near vested in the Social Security system yet. So it's going to be around for you. In what shape and manner, we don't know. Of course, time will tell, but just know that Social Security is going to be here. Well, then again, retiring in the 60s and 70s and 80s and even 90s, it was pretty darn simple, right? You had Social Security. Maybe that's 40% of your pre-retirement income that you have coming in your retirement years, which that's what Social Security is designed to replace on average, around 40% of your pre-retirement income, just on average across the country. But then you have these beautiful defined benefit plans, right? Who has a defined benefit pension plan? Those of you on the call, tell me, do you have a defined benefit pension plan? These are pretty beautiful, right? It's kind of the same as Social Security, except it's not the government guaranteeing you a paycheck for life. It is the employer that maybe you put 20 years on the clock with that is now paying you for life. So yeah, of your pre-retirement income, you're able to get that, maybe 80% of that or so in Social Security plus a pension plan. Well, being retired in 1960 was pretty darn easy, right? Well, I'll tell you, the dynamic has shifted, and I don't see any, but Linda does. There's only one person that has commented that says that they have a defined benefit pension plan. Why is that? Because a lot of them have gone the way of the dinosaur. Because people, same thing that I said about Social Security. People are living a long, long time, and as a result of that, the employers can no longer afford to offer them. So the point here is here is what employers have done. They've said, hey, we are going to switch over to this new deal here. And what is the new deal that employers are generally offering their employees today? In replacement of defined benefit plans. What is that? Tim, I have two small ones. Excellent. That's right, cash plans or 401k plans, 401k plans. So it is now, hey, we're just going to give you a match here, but when you retire, you go off into the sunset. And I know you're not a money manager yourself, but good luck to you. We hope that you do not run out of money, right? We hope that you don't live until you're 100, which means you may very well run out of money. But all that I know, the employer, is I'm not going to guarantee you that lifetime paycheck that I did say 20 years ago. Things are a heck of a lot more difficult today than they were back then. So this is why these are the three wonders of the world, by the way. Number one is Social Security. You got to maximize your Social Security. You got to optimize it, which after this slide, this is where we're getting into the nitty gritty and how you do this stuff. Number two, pension plans. A point that I always make on pension plans is this. I will say that I deal with this every week to where many pension plans will say, hey, we will give you a lump sum or we'll give you a lifetime payment. 20 years ago, the lifetime payment was almost always the way to go. But I will tell you that with where interest rates have gone, many times that lump sum payment to where we can go out into the marketplace and replicate a pension payment higher than what your pension plan otherwise would have done, we can do that a lot of times. But in short, pension plans, whether it's us maximizing it for you or just keeping that employer plan, they're beautiful things. It's lifetime income. And lastly, annuities. I don't talk about annuities a whole lot on this call. This is not a big annuity pitch, but I will tell you, annuities have never been better than they are today. So think of this. This is what I did. I'll give you a little tidbit on I'll spend about 2 minutes, a tidbit on what I did 2 years ago. I know I don't look a day over 18, but 2 years ago, rather, I was 46. Like, you know what? I'm getting old enough to where I can actually buy some of these income-focused annuities. So I scanned the entire industry. We have the software, right? Andy has the software. I have the software. And I said, if I were to dump $200,000 into the highest paying annuity in the industry, how much will that give me when I retire at age 65, for instance? And I'll ask you folks, how much do you think? So age 46, I want income 19 years from now. I put in $200,000. How much annual income, in addition to Social Security, in addition to my wife has a little pension plan, IPERS here in IPERS. You know what IPERS is. She's a teacher, right? Here in Iowa. So in addition to that, how much annual income is $200,000 going to generate for me when we both retire, say, at age 65? Steve, that's pretty good. Usually people are a lot lower than that. The answer to that question is $44,000 per year. $44,000 per year. You put in 200 grand, 19 years. And by the way, if 5 years later I want to cash it out, I can. Just know that there are charges and stuff if you cash it out early. What if I die? My wife gets whatever the balance is, right? It's not like the insurance company keeps your money. But I will tell you this, these are the three wonders of the world when you think about giving yourself permission to spend and enjoying your retirement. I'll give you one soapbox talk, and Andy can speak to this as much as I can because we both see it at least on a monthly basis, me on a weekly basis. When people retire, do they do what they dreamed of doing? So in the pre-retirement years, right, you bust your butt. You save because you're going to create all this money. And then when you retire, the goal is you're going to get a country club membership. You're going to buy a boat. You're going to buy a lake house. You're going to whatever, travel the world. Well, let me ask you a question. When people actually even hit their goal and then retire, so they hit their money goal, do they, in general, actually enjoy their retirement as much as they thought that they would, even though they hit their savings goals? Do they enjoy their retirement as much as they should? People are saying no. Why is that? Why don't they? What are they worried about? What is the number one fear that consumers have that are retiring today? What is their number one fear that stops them from buying that boat, from buying that lake house, from buying that country club membership? They're worried they're going to run out. They're worried about this thing called longevity, right? Think of permission to spend. Oh, and by the way, here's what happens. They die with a war chest of money that they never enjoyed. That money goes to the kids, right? And what do the kids do with that money? That boat, that country club membership that they wanted prior to passing. The kids buy that stuff, right? Social Security, pension plans, and annuities give you permission to spend. My point there is spend your money. Spend your money, folks, right? You've earned it, spend your money. But you have to address that. That fear doesn't go away. So how do you address the fear while spending your money? Those are the three different ways. Optimize Social Security. Many of you don't have pension plans, but consider annuities. Social Security is the base of all of this for a lot of you. For a lot of you, this is the largest asset, so to speak, that you have. Like I said, it's not hyperbolic to say that this is a seven-figure income stream over your lifespan. Let's see. Couple comments here. No, worried they will run out. Yep. That's right. Will I be able to pay for everything or run out of money? Yeah, that's right. Donita, I hope I'm pronouncing that right. They are used to making money on a regular basis. Yeah, it's like, it's like the uneasiness that us guys get. You're seeing that gas tank drop, drop, drop. Now all of a sudden you have to get comfortable with this in retirement. It's like you're on a long trip, and us guys, Andy, I'm sure you've never done this, right? Let the gas tank get a little empty. You pass the exit because you're too late. I'll get off on the next exit. And it's really bumping up against the, like, damn, I don't know when the next exit is, right? That's that uneasy feeling that a lot of folks might get in their retirement years. Well, there are ways that you can avoid that gas tank going empty there. So let's get into full retirement age. So for Social Security purposes, it's important that we know where to start with the calculations. All calculations that the Social Security Administration, whether you file early, whether you file late, it starts with your full retirement age. And folks, here's your full retirement age right here on the screen. I was born in 1977. So down here, 67 is my full retirement age. Like I said, my 16-year-old was born in 2010. His full retirement age is 67. All this stuff's going to get it, that's going to get adjusted for the younger folks there. So this is very relevant because at your full retirement age, whatever that big bold number was on your statements as the years have gone by, $2,000 a month or $3,000 a month, that is assuming that you file at your full retirement age. But if you file early, it's not going to be that big, bold number. If you file later than your full retirement age, it's not going to be that big, bold number. It's going to be a better number, right? So let's take an example here and let's talk about logistics. Kind of get you in the mindset of, you're going to go through this process eventually. What do you expect when you go through the process? What's the timing? When does the check show up? When do you need to alert the Social Security Administration? All right, so let's say we have Mike. Let's say Mike. Mike is born in 1956. Let's say March 3rd, 1956. So Mike says, you know what? I sat down with Andy and Charlie and they created this optimization report for me showing how to get the biggest number on an after-tax basis over my life. And I want to file at my full retirement age. So I want to file when I'm 66 and 4 months because that's when the Social Security Administration says that that's his full retirement age. So that means, let's see, he turned 66 in the year 2022, right? March 3rd, 2022. Folks, is that his full retirement age based off what I just said? So is March 3rd, his birthday, is he at his full retirement age yet? No, he's got 4 months to go because full retirement age per Social Security is 66 and 4 months. So that means, let's see, 1 month, 2 month, 3 month, 4 month. That means July 3rd, technically it would be the following month. Well, it wouldn't even be the following Monday because that's July 4th. That's a holiday. Technically, it would be July 5th would be his full retirement age. So that is when he wants his date of entitlement. That is when he wants his Social Security benefits payable. Okay, so when does he need to alert the Social Security Administration? I'll tell you, the Social Security Administration says, do not call us up when you're 50 years of age and say that you want to file for your benefits at 66 and 4 months. We don't want to hear from you, at least until this window right here. What is that window? The window for notifying Social Security opens up 4 months prior to when you want your benefits to begin. So in this case, our guy, Mike, his window started in March and it went through what we're looking at here, right? So that's the 4 month window. Side note here, this is different than Medicare. When you hit age 65, there is a 7 month window for Medicare. Completely different than Social Security, but if you do not file for Medicare at age 65, and if you're not exempt, exempt meaning you're a part of a big employer's health plan, then you might regret not filing for Medicare at age 65. Why is that? Because for every year that you procrastinate and don't file for Medicare at 65, again, assuming you don't have an exemption or anything, then it's a 10% penalty or so for every year that you procrastinate that you will have to forever pay to the government because you delayed past this window that I'm talking about here. So what's the Medicare window? It is the month that you turn age 65, the 3 months prior to that, and the 3 months after that. When you turn age 65, that is, or 3 months prior to 65, that's when the window starts for you to file for Medicare. And if you're not exempt, you do not want to miss that window, right? So my point there is that's Medicare. And this is Social Security, 4 month window with Social Security. Sorry for the Medicare question. I am on my wife's plan, so if I want to stay on it, I don't have to worry. Yeah, I'm not a Medicare expert when it comes to that, Tim, but yeah, I would imagine you wouldn't have to worry. Um, and if you want to, I mean, I have the handbook right here. If you wanted us to research it, I would say just put that in the evaluation comments at the end. Folks, the evaluation at the end here, and we're just getting into the nitty gritty here, by the way. The evaluation comments, or in the evaluation, we are going to ask you a few things. Number one, how did we do? But also number two, do you have any questions for us at all? Kind of like that, Tim. But by the way, keep asking questions as we go here. But also number three, do you want that retirement income plan? It's free, folks, and there are no strings attached. Oh man, what are you going to try to sell us, Charlie? We don't try to sell you anything when it comes to that, okay? Well, then how are you able to do that? Because guess what? Because call it marketing, call it what you will. If we do a good job helping you plan for your Social Security, and I've seen this play out time and time again, and when it comes for you to retire, whatever, like, you know what? That Andy guy, that Charlie guy, they really helped me out. And as a result, I need a new financial advisor and I'm going to use them. You know, that's how it works. So you're not going to get a bill for any of this stuff. Okay, folks? So those are the things that we're going to ask you in the retirement income plan there. Okay. So he files for Social Security with the effective date being his full retirement age. When does his direct deposit in the bank account come? The following month. So it's a month in arrears and it's on a Wednesday of the following month. Which Wednesday? I won't go into that a whole lot, but yeah, it's a month in arrears on one of those Wednesdays that you're going to get your Social Security check. So logistically, that is just giving you what to expect when it comes to getting your Social Security. Now let's get into the fun stuff here. So at Mike's full retirement age, which is 66 and 4 months, like we said, that number on his Social Security statements, maybe it was $2,000 a month or whatever. That number is what he gets 100% of. So he would get $2,000 a month when he files at 66 and 4 months. However, what happens if he files early? What happens if he wants to take that benefit, say, a year earlier? Now, the months are kind of funky here, but I'll tell you a rule of thumb. It is this: for every year that you file for Social Security benefits early, it is around a 6% penalty that you get forever, around a 6% penalty. So if you file 2 years early, it's around 12% less than if you otherwise waited until your full retirement age. Say, like me, my full retirement age is 67. If I filed as early as possible, which is age 62, then how much of a penalty is that I'm going to get? Well, that's 5 years early times 6%. It's roughly around 30% penalty that I will have forever. Now, conversely, folks, when you go the other way and when you delay filing past your full retirement age, the smart folks on the call here, tell me, what is the percentage that you get in more benefits for every year that you delay past your full retirement age? Every 12 months you delay past your full retirement age, what is that percentage higher that you get? Nobody knows this? I know that somebody knows this. You're too good of a group to not know it. Pam. Of course Pam knows that. Pam's smart. 8%, 8%. So, and again, the months are a little funky here, but if you go 8 months past, it's 5.3%. But, for me, age 67 is my full retirement age. And if I delay until age 70, that's 3 years past times 8%. That would mean that I would forever get a 24% larger benefit. And remember, in my situation, if I pass away with that big benefit because I waited a long time, what does my wife inherit? Because it's larger than her benefit. The surviving spouse gets the larger of the two, right? She would get that big benefit that I was getting because I delayed my Social Security benefits. So if I were to put in an oversimplified, and I emphasize oversimplified, nutshell of what the Social Security calculus is, I would say that it's this. Do you file for Social Security early and get less of a benefit for a long period of time? Or do you file for Social Security late and get a larger monthly benefit for a shorter period of time? 8 years shorter, if you're looking at the difference between 62 and 70. Which one is better over the long run? And a lot of folks will say, well, I can do that calculus with just a simple spreadsheet, There are different crossover points and all that. No, you can't. That's greatly oversimplified. You need a system that's going to tell you, hey, off into the future, here is your taxation on Social Security, which is based off your tax return, by the way. We can show you your projected tax return when you're age 80, for instance, age 82, age 83. And within that tax return, you have the standard deductions and all that. But then in the end, it is boom. At this age, your Social Security, whatever, 50% or 85% of it will be subject to taxation. So what we're able to do with this analysis is we are able to figure out how to get you projected. All this is projected, of course, the largest Social Security amount over your lifetime that we can possibly get you. And again, that's that free retirement income plan that we talk about here. Let's see, Pam. I once did it and it balances out around 72 or 77. It'd be closer to 77, Pam. But again, just doing that kind of the spreadsheet, age 62 and then age 70, it's oversimplified because you're not taking into consideration taxation. Most of them are not taking into consideration inflation. And by the way, what happens when you're age, for many of you, age 75? What happens with your pre-tax assets when you hit your 70s? And it varies depending on what year you're born. But what happens when you hit, for a lot of you, age 75? What does the government require you to do with those assets that have not yet been taxed? Required minimum distributions RMDs, they force you. That's right, Brian. Well said. They force you to withdraw them. Well, that doesn't sound bad. You're getting money, you're withdrawing money. No, when you're trying to minimize taxation on Social Security as well as a ton of other things, those RMDs can actually implode your financial plan. Do you have a way to project out what your required minimum distributions are? Run that through your tax return in the year 2040 so that it tells us a whole picture of what your retirement is going to look like unless you make certain changes, adjustments, optimizations. That's the type of planning that we do with this stuff. Oh, yes, it's our fluffy puppy dog here, which means it's poll time. So here's a question, and this is on purpose a little bit of a surprise for you. We haven't covered this yet, but we will, and it is this. When it comes to survivor spousal benefits, what is the earliest age that a surviving spouse can file for Social Security? So when you think of a spouse that's passed away, which I'm sure is a couple of you on the call, every room that I do these in, it's usually the ladies. Why is that? Because the ladies outlive us guys. There's usually a widow in there, right? So the question is, when can that widow tap into, or widower tap into the person that's passed away, their Social Security benefit? They're coming in. The smallest bar is the one that is actually correct so far. I'll tell you, this frog in my throat. I've had it for like 2 weeks and it's getting old. The answer to that question is this. The answer to that question, I'll end poll and I'll share the results here with you. It is actually age 60. So what that means is my wife and I were married, obviously. If I were to pass away and if she were 60 years old, she could actually get benefits, get my Social Security benefit as early as age 60 by her filing at age 60. She doesn't have to wait till age 62 for her to tap into my benefit because she was married to me for at least 9 months, which is what the rule is. She can tap into my benefit as early as age 60. Now, it can get kind of complicated, but very cool. It can get kind of cool and complicated when, okay, but can she tap into hers at age 62? Yeah, she can. So at age 60, she could file for spousal survivor benefits and get that off into the future while her benefit increases on the sidelines. And then maybe at age 70, she switches over to her benefit, right? But just know that if you've had a spouse pass away, that it is possible that you can actually file for their benefits as early as age 60. If I am single and have an adult child, can they get Social Security from me? No, not an adult child, at least when it comes to Social Security retirement benefits. Um, that's a good question. I never got that question, but I could see why one would think that. Well, heck, if two spouses that are married, if one could get the benefit from the other, why can't I with an adult child? The answer is no, you can't. All right, so let's get in some more nitty gritty here. Okay, so here's your Social Security statement here. So in our example here, Wanda Worker, her number over all these years has been $1,500. At her full retirement age, that's what she's going to get. So if she files at 67, she's going to get 1,500 bucks per month. Let me ask you guys and gals a question. It's kind of an averaging calculation, right? So what she's made over all those years, you kind of average those out, kind of. That's greatly oversimplified. There are bend points and all that other stuff, but you average those out, and that's how the Social Security Administration arrives at her $1,500. Well, let me ask you a question. What is it that determines that average formula? How many years does the Social Security Administration take into consideration? The answer to that, I'll just give it to you. It's 35 years. So let me ask you a question. Now you have to answer this. Is it the best 35 years or is it the worst or is it the last 35 years? So when the Social Security Administration calculates your Social Security amount, they take 35 years of your earnings. Is it the last 35 years or the best 35 years? It's the best. Excellent. Great. Yes, all of you got it right. It's the best. Why do I bring this up? I don't bring it up just for mental gymnastics here to show you all these little nuances that I know. I bring it up because these are the questions that I get. Charlie, if I go back to work and don't make much money, is that going to hurt my Social Security calculation? Based off what I just said and logical reasoning, can they hurt their Social Security payment by going back to work and not making much money? The answer to that question is no. They can only help their calculation in that the Social Security Administration takes the best 35 years. So unless you have another best year, it's just not included in the calculation, right? So unfortunately, I've gotten the question of, hey, I need to go back to work. These were not my clients, by the way, that asked these questions. Fortunately, a lot of my clients, they retire and they go away as they should. Go away and enjoy their retirements. But Charlie, I have to go back to work. If I greet people at Walmart or whatever and only make whatever, 12,000 bucks or whatever, is that going to hurt my Social Security calculation? The answer to that is no. What might hurt their Social Security calculation is what? If they make a lot of money, what might that introduce into the Social Security calculation now? So where might it hurt them? Not the actual Social Security calculation, but when you think of net Social Security, what am I referring to? That's right, taxation. Taxation, which means they might get less net Social Security, right? And we'll talk a little bit more about taxation in about 5 minutes here. So when one files for Social Security, like her number was 1,500, does that mean that that's what she's going to be at from now into perpetuity forever? No, the government has these cost of living increases that adjust your Social Security year by year. So you can see here, 2025, our inflation gauge, I use that in quotes. I won't go into why I'm not a huge fan of the inflation gauge we use, but it's 2.8%, right? What does that mean? It means in January, when you got your 2026 Social Security check, now all of a sudden you're getting if you were on Social Security already, you're getting 2.8% more in Social Security per month. Looky here, 2023 when inflation was horrible, right? 8.7%. Well, January of 2024, you're getting 8.7% more in Social Security. So that's pretty cool. So although, we use the number at your full retirement age, most of you know that it doesn't stay there forever. We, of course, increase it year after year for cost of living adjustments. Spousal benefits. So take me and my wife, for instance. Let's say that my Social Security benefit is based off of my earnings, right? My 35 years. Remember, my best 35 years. Let's say that it's $4,000 a month. My wife's based off her earnings record, which isn't much. She stayed at home raising kids while I traveled the world doing this stuff, right? By the way, ladies, who had the tough job of the two of us? And I have a point around this. Who had the tougher job of the two of us? Wasn't me out there doing what I love here, that's giving me a Social Security benefit of say $4,000 a month, or her who's only down to $900 per month. She's a teacher. Before she was a teacher, she raised our kids, right? Well, I traveled. So the fact that she had actually had the tough job, a huge contribution to the family, even though it's not reflected in the Social Security number, the government recognizes that. So what they say is Charlie, yours is at 4,000, and if your wife's, Noelle, is not at least half of that, which is $2,000, then guess what? She gets $2,000. So she gets 50% of what Charlie's is, or vice versa if the roles were flipped here, right? There are a couple of caveats here, though. One is If she doesn't get, she can't say, well, heck, if I'm going to get 50% either way, then I'm going to file at 62. No, it doesn't work that way. The government will take that $2,000 and still penalize her if she takes it 5 years early, right? Oh, here's another one. Um, Divorce spouses. So you've been married to somebody for 10 years and maybe you married a sugar mama or a sugar daddy or whatever. They made a ton of money. You can actually get 50% of their benefits. A lot of times people are like, well, are they going to know that I'm piggybacking off their benefit? I don't want my ex to know that. No, they're not going to know. They don't know that. Well, is that going to hurt their benefit? No, it's not going to hurt their benefit either. A lot of times folks are like, damn, I want it to hurt their benefit there. Nope, they don't know. It doesn't impact their benefits. There's a big caveat, Brian, haha. There's a big caveat to the spousal benefits, and it is this. My wife's benefit is like 900 a month, right? If I do not file for my Social Security benefit, hers is going to be 900 a month. I have to file for mine in order for hers to bump up to that $2,000. In other words, you cannot piggyback on your spouse's benefit if they have not yet filed for Social Security. Hope that makes sense. Case studies here. Case studies. And we're going to talk a little bit about taxation, and we're done at around 6:45 or 6:50 here. 75 minutes is usually our webinar time here. Are you folks getting anything out of this? Are you enjoying this? Is it just boring as heck? Is this great? Is it the best ever, or is it the worst ever? People are, or somewhere in between. People are saying, loving it, awesome. Well, I appreciate it. That's a good group. Tyler said mid. This ain't mid. Jeez. All right, so hypothetical example here. So here we are going to, and he was just kidding, of course. By the way, Tyler is one of the leaders over there at RIA Group. He's just, well, he's messing with me. So here we have a couple. This is optimizing your Social Security. This is where it all kind of comes together here a little bit. Greatly simplified versus what we do for you. And we even simplify it as much as you want it simplified. Want it simplified when we do it for you. Just know that when we do it, we're able to look at your tax returns off into the future and all that, but we come back to you with an easily digestible suggestion of, hey, if I were you, here is where, I would look at filing for Social Security. So here we have Paul, age 62. He was born in 1961. Somebody, when they're thinking of Social Security, what's the first thing you think about? Okay, born in 1961. What's the first thing that I need to know? Well, the first thing I need to know is what's his full retirement age, right? That's right, Steve. 67 is his full retirement age. Linda, she was born in 1963. The first thing, the anchor of all of this, the anchor of all of it is age 67 as full retirement age. We're going to assume that they lived to 86 and 89 respectively. Oversimplified. We're not going to assume any inflation. We're not going to assume any taxation or anything, which we do in our real simulations, but not here. So here's what we're going to do. They're both going to file early. What does that look like from a Social Security standpoint? We're going to take the other side of the spectrum. They're both going to file late. Then I'm going to show you the optimal. All right, so here we have both of them filing at age 62. All right, let's see here. We have a couple comments. My mom divorced after 20 years. He remarried and she did not. She filed for Social Security and received money off my dad. That's right. Social Security had to notify stepmom that mom was getting this money. That doesn't make sense. There shouldn't be anybody being notified about that. Interesting. Yeah, there shouldn't be anybody. I'm curious of the circumstances there. But yeah, great feedback there. All right, so Paul's primary insurance amount, right? Primary insurance amount, in other words, is the full retirement benefit. That's what PIA means, which I didn't mention before. Primary insurance amount is the full Social Security benefit, assuming he files at his full retirement age. But that's not what he's doing here, right? So that $2,400, because he is filing at age 62, that actually reduces down to $1,680 per month. That's what he's going to get for life. Again, less of a monthly amount, but for a longer period of time. Here we have Linda. Her primary, so check this out, folks. Her primary insurance amount, like my wife, right? Say $900 a month. When she files at age 62, she's getting $852 a month. Why is she only penalized? She's not penalized much, right? I mean, heck, $852, that's almost her entire primary insurance amount. What is going on here? Why is she only penalized like $48 even though she took her Social Security 5 years early? Anybody know what's going on there? Well, let me give you a hint, then maybe you'll get it. It's not about her $900 for Linda, right? It's not about her $900. What is it about? It is about 50% of Paul. It's about that spousal benefit. You see, Paul, that's right, 50% of his, Brian. Paul's is 2,400. So her calculation actually starts at $1,200, assuming he's applied for Social Security, which he has because he's what, 2 years older than her, and he filed at age 62. So $1,200 is her number. And yeah, you discount that back for filing 5 years early. She's only getting $852 a month. So like what we do, what is the total benefit over the lifetime? $809,000. Okay, what if we go the other extreme? What if they both file at age 70, for instance? What does that do for us? Well, Paul, remember his primary insurance amount was $2,400, but he files at age 70. That means that he's going to get 24% more per month, right? So almost $3,000 per month. What about Linda over here on the right? Linda's primary insurance amount is $900. Remember, it's kind of not about her primary insurance amount though, right? She files at age 70 and she's getting only $1,200 a month. Why do I say only? What is a little curious about this right here? She filed at 70. She sat around waiting for what, 3 years, when she could have filed at age 67 and gotten $1,200 per month. Why is she only at $1,200? Folks, this is the number one mistake right here that I see people about ready to make until I talk with them. And it is this, that there are no brownie points. There are no delayed retirement credits for Linda when she files past age 67. There are no delayed retirement credits when it comes to the spousal benefits. Well, that doesn't make sense. The government will penalize her for taking it early, but they will not reward her for filing late. That's correct. There are no brownie points when it comes to spousal benefits. So think about that. She sat around and wasted 3 years expecting to get a higher benefit than just $1,200 per month. Do you think the Social Security Administration called her up and said, "Hey, Linda, FYI here, you're leaving money on the table"? No, they don't call her up and do that. Okay, so we run all the different combinations, and what is the best combination from a Social Security maximization standpoint? By the way, that's $951,000 in benefits. Here's the optimal scenario is that Paul, he files at age 70 here over on the left, right? This is the optimal scenario, and he is going to get almost $3,000 per month in benefits. By the way, when Paul passes away, ultimately Linda is going to inherit his $2,976 a month. What's Linda's optimal scenario? Her optimal scenario is to not wait until age 70, as we just talked about, right? Her optimal scenario is to file at age 67. And when she files at 67, she's going to get $900 per month at that point. Why, folks, is she only getting $900 a month? We've been talking about this 50%, half of Paul's and everything. Why is she only getting $900 per month when she's age 67? Why is that? Boom, Brian. He has not filed yet. That's why. He files a year later. Remember, he's 2 years older than her. He files a year later. Then guess what? Her benefit pops up to $1,200. And you add all that up over their lifetime without inflation. You can see here when I'm talking $1 million this, $1 million that, this is not hyperbolic language here, right? That's $991,000. So of the three scenarios, Both of them filing at 62, they would have left almost a couple $100,000 on the table. Both them filing at age 70. Linda is wasting almost $40,000 over that 3 years sitting around waiting for those delayed retirement credits that never come, right? The number one mistake that I see, to where the optimal scenario, they're leaving zero money on the table there. All right, earned income test. You file for Social Security early. You file for Social Security early, and you still have earnings, right? You still have tips, you still have wages, etc. Here is the perfect bad scenario, to the penny, the worst scenario that I came across like 5 years ago, and I'll relate it to today's dollars. What is this? I have a couple questions. Does RIA Group work with clients throughout the Midwest? I'm not in Des Moines, but love to put together a plan. Andy, do you want to answer that?
Sure. The answer is yes. We have advisors in several states and we go across borders. So we love the opportunity to see if we can bring value to what you're doing. So yes, we'd be happy to help.
And somebody asked a question earlier, Andy. I didn't cover it because I was knee deep in the Social Security stuff. My current advisor just manages my investments. We've never discussed Social Security or my income needs. Can you help me with? Can you help me with then just investment? So can you help them with just investments?
Well, the answer is, of course, but I'd also say my experience says there's really no independent financial decision. So we do a pretty good job of asking questions because we want to try to deal with all of the pieces of the financial landscape for you. So investments being the most important, but if we understand what's important to you, then we have a better shot at addressing it correctly.
Beautiful. And you guys do everything: investments, insurance, long term care, life insurance, securities.
I just ask what's the goal? I mean, what's the plan? Most of us shoot at nothing and hit it with great accuracy. So we kind of start with the end in mind and say what's most important to you, and then try to craft a plan to address that.
Planners versus salespeople, right?
Right.
Kind of a breath of fresh air. So this is a perfect negative scenario. About 5 years ago, this lady says, "Hey, I'm 62 years of age. 62 years of age. Should I file for Social Security early?" I said, "Do you have any earnings?" And I'll relate it to today's dollars. She said, "Yeah, I make about $65,000 a year, right?" I said, "Okay, $65,000 per year. So that is $40,000 above this threshold, right? $40,000. I said, "Okay, so do you realize that the government's going to withhold from your Social Security 50% of everything that you make above this threshold here?" He goes, "I didn't know that." I said, "And you said 65,000 bucks. So that's 40,000 bucks above this. They're going to withhold half of that, which is 20,000. And how much does your Social Security statement say you are going to get by filing today at age 62?" She says 20,000 bucks. I said, "Then you aren't going, if you file now, you're not going to get a penny because they're going to withhold $20,000 because you make 65 grand and your Social Security is only 20,000. That is the way Social Security withholding works, and that only applies to when you file prior to full retirement age, right? So that's a tidbit. If you're filing prior to full retirement age and have any earnings coming in, you want to talk with Andy. You want to talk to the RIA group because be very careful. The government can withhold that. Now, very important. So we're going to delineate here. So that applies if you file early for Social Security. Social Security taxation, on the other hand, this can apply anytime. You could have a 90-year-old that's been on Social Security for 25 years and they can be subject to taxation. Okay, Charlie, so you were talking about 85% of Social Security being taxed. How much does it take in income for me to have 85% of my Social Security taxed? Only $44,000 if you're a couple. If you're a single person, it only takes $34,000 to have 85% of your Social Security taxed, right? I'm not saying your Social Security is taxed at an 85% rate. I'm saying that 85% of your Social Security is subject to taxation. Okay, well, what's a part of the calculation? Oh, by the way, before we talk about provisional income, then we're going to close it out here in 5 minutes and you guys can fill out the evaluation here. We have another poll. This is a tricky one because I just said it kind of quickly here. So if you weren't paying attention, you might miss it here. All right, so let's relaunch this poll right here. Boom. Here's the poll. If you file for Social Security prior to full retirement age, what can you potentially be subject to? Is it taxes? Is it the withholding that we talked about? Is it neither of the above? Or is it both of what we just talked about? Yep, everybody's getting it right. It's both. Taxation is always beware of taxation. Taxation is always. You all got it right. However, the earnings tax thing or the earnings withholding, I should say, that is prior to your full retirement age here. All right, so here is the calculation. Provisional income, that's the $44,000 level that I'm talking about here. So Charlie, is it just earnings or is it just income from investments? It's everything basically. Your gross income, which includes those, as we started this, your pre-tax dollars coming in from your 401k, from your IRA. Folks, there's a reason I droned on about this stuff. Required minimum distributions, pre-tax accounts, you now have income coming in that's adding to your gross income, which is adding to your provisional income, which is adding to your Social Security taxation. All of this stuff Social Security relates to all of this stuff and how it's made up isn't included in your gross income. How does earned income, if I receive military retirement and will receive another government retirement check in a couple of years? My RFA, yes, government. Good question. Could be a combination of things. I would suggest talking with RIA, talking with Andy about that, because it can be a few different things. If we're talking military stuff, I won't go into the details here, but it can be a lot of different things there. So it probably will impact your provisional income, make it bigger, which can subject your Social Security to taxation. But without more information, I don't want to make that blanket statement. Last slide here. So here is what somebody, military, thank you for, yes, thank you. Yes, thank you, Brian. Military, thank you for your service. All right, so here's a couple that came to me about five years ago, and I've had hundreds since that I could show you examples of. This is a printout from their retirement income and Social Security plan. They came to me and they said, hey, Charlie, here's a couple of Social Security statements. I don't know what the hell they mean, Charlie. And here's a couple of our brokerage statements, like $500,000. So we're going to be taking that income at the same time as Social Security. So we don't know what any of this means. We want to retire a year from now. What does this mean from a lifestyle standpoint? And this might be a lot of you. You have a bunch of money, but what does that mean? Does it mean you can spend 100 grand a year? Does it mean you can spend 50 grand a year? Does it mean you can spend 300 grand a year without running out of money? I said, so here's what we're going to do. We're going to arrive at what your current number is, the way everything sits, and you filing for Social Security now because you say that's when you want to do it. But then what we're going to do is after we arrive at that after-tax number, we're going to optimize your number. We're going to look at adjusting Social Security. Here we actually proposed an annuity as well. We're going to look at an annuity that may be able to bump your income up. Well, I said that after the fact, after we analyzed it. And we're going to see if we can get your number larger than where you sit today. She walked in, it was what, $40,000 a year after tax. When she walked out with the plan, we're getting her roughly a projected, we project her lifespan, of course, and her husband, almost $700,000 of additional wealth over their lifetime by adjusting Social Security, adjusting their portfolio, maybe adjusting the taxation and how this stuff interplays. So that's the retirement income and optimization plan that we talk about here, folks. And Andy, that's my last slide. I went about 4 minutes over. And if you want to close us out here, the audience is great. Great, very interactive audience. Audience, stick around. The evaluation will take you like 30 seconds. But Andy, if you want to close us out here, fire away.
Well, I'll just be brief. Thank you, Charlie. I think that was some great information. I think we all better understand that the decisions we make in retirement can have a lasting impact on the years to come. And don't leave what you're doing to chance. You've all started the journey. Take the additional time to make a retirement plan that helps protect what you guys have done and the benefit available to you, as Charlie said. So we're here to help. Charlie's here to help you get started or further your success in retirement by developing a plan. If you'd like to engage us or just have questions, there's no obligation, there's nothing, no expectation on our part. Reach out, let us know how we can help, and we'll probably send you all an email of a thank you email expressing gratitude for you and for what you do. So, uh,
Andy, one
Charlie,
last
thank you.
question popped in before we go.
Yeah.
I have money saved up in my 401k. How do I turn it into income? Call Fidelity to have them send me a check? Question mark. Our competitor.
Well, that's a loaded question. The investment options available to you um, focus either on accumulation and or on distribution, meaning if and when you need income, it might be a different tool than just growing the pile. So we have to determine how is the pile going to serve you in retirement and what are your needs. So it's a depends on answer. So that's what we do in terms of making sure that your needs are met in retirement with the right tool.
Excellent.
So reach out again and we can dive deeper on a more specific and better question or a better answer to that question. Again, thank you. We applaud you for taking the time to invest in your futures. Appreciate you.
Thank you, everybody. Evaluations popping up here in about 10 seconds. Thank you much.
Thanks, Charlie. Bye.